Benchmark indices continue to consolidate just below the flat line for the frontline indices. We have financials and realty being the big draggers, whereas IT is an outperformer. The mid-caps underperform a tad.
A steady debut on bourses for HDFC Bank, backed HDB Financial. The shares list at a premium of 13% to its issue price. We'll be joined by the management in just a few minutes from now.
IndusInd Bank is among the top Nifty losers in today's trading session. There is a note that is coming from Goldman Sachs. They've downgraded the stock to sell rating, target of 722 rupees. They're saying the bank is structurally weaker now, with return on assets to reset lower.
Dreamfolk trades lower after the company informs exchanges of certain program closures, which could have material impact on its financials.
Inox Wind trades higher after Motilal Oswal initiates coverage on the stock with a buy rating, target of 210 rupees a piece. They expect the company to deliver strong EBITDA compounding of over 38% for the next 3 years.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and with me is Mangalam, and the market's a little bit off color. But we've got a couple of, IPOs that listed today. HDB Financial made its debut on the Dalal Street today, listing at a premium of around 13% to its issue price. To discuss the company's plans, the outlook, we're joined by Mr. G. Ramesh, the MD and the CEO of HDB Financial. Hi, sir. Good morning. Congratulations. A big event, a lot of hard work gone in there, and those that got the share in the IPO, they'll be happy because the stock is listed at a sharp premium. That said, this time around now, you can give us some kind of an outlook. So what kind of a growth, AUM growth are you looking at for this year? If you could help us out with that. And what kind of rough NIMs should we work with? Please go ahead, sir.
So thank you first of all for inviting me to your studio. It's a day for our listing. Thank you very much for inviting me. As you know, this is the largest NBFC IPO in the history of India, 12,500 crores. We also have the largest applications for a $1 billion plus IPO in the last 4 years. So first of all, thank you to all the people and all the investors who have shown active interest in our stock. We had over 22 lakh retail applications. So thank you very, very much. Now, in terms of our growth, we are a 17-year-old company, been through cycles. We understand the cycles and we understand India. And our whole focus has been on targeting aspirational India through our products and services. In the last 3 years, we grew at a CAGR of about 20%. And I think that's a number that we are quite comfortable with.
All right, 20% and HDFC go hand in hand, and HDB Financials, we don't expect any different for them as well. But, I'd like for you to throw some color on what would lead this growth, because I'm looking at your book. About 40% is enterprise, about 37% is asset-backed, and consumer finance, which a lot of people are eyeing, is just about 20 to 23% of your book. So going forward, what is the ideal mix that you would have, and which of these will outperform?
We are a customer company, not a product company. We have had a long journey of introducing new products, and it's part of our DNA. We launched enterprise lending in 2008, and we launched asset finance in 2011, consumer finance in 2016. So consumer finance is our newest business. It was about 13% about 5 years ago. It's 23%. We believe that all our businesses that we are in have an opportunity for growth as India grows over the next few years and decades. And what we're really trying to do is to make sure that we have adequate capital allocation in all the aspects of our customer, whether it's the business or personal needs, and that's how we think about growth.
What, according to you, would be the ideal mix? Would it be 1/3, 1/3, 1/3?
So we don't have really a target. I mean, so what we would like to have is a very diversified book so that we can manage business cycles. So there'll be businesses that have a certain low and a business that have an opportunity. So what we're really trying to do is to have a well-balanced portfolio. Don't have a target in terms of mix, but in terms of opportunity, I think a 1/3 mix would really make sense.
All right. And, borrowing from banks, I think, is approximately 1/3 of your total borrowing mix?
That's right.
All right. And, we have a couple of rate cuts that have come about. How does that tie into things, and what should the rough margin band we should work with?
So, a rate cut cycle is obviously beneficial for a company like ours. About 70% of our book, more than 70% of our book is on fixed rate, given that the customers that we work with and our retail book, as you may know, our top 20 borrowers is less than 0.34% of our AUM. So that's the level of granularity. So a lot of small borrowers that we lend to are extremely comfortable with a fixed rate kind of asset scenario. And so that's what we work with. And a rate cut cycle obviously benefits both the lender and the customer. So that's something that we look forward to as a company. Historically, our gross NIMs have been in the region of 7.6 to 8%, depending on the cycles. And again, our focus is on diversifying our product, and within the products are micro segments so that we can deliver a reasonable risk-adjusted return.
And this band that you've been speaking about historically is likely to continue irrespective of what the cycles are.
That's right.
Perfect. What about your return on assets? I'm looking at your return on assets. So the last few years, 3 years in particular, they've been contained between 2 to 3%, while the same for your peers have been a lot higher. What is your plan to increase or improve your return on assets, sweat your assets a little better from here on?
So our plan to improve that would primarily focus on the product portfolio that we work with, the customers that we work with, and within the customer segment that we work with, the product customer segments that we can work with so that we can generate a reasonable risk-adjusted return. That will be our strategy.
And would you have a target on how much you would like to improve this to, any sort of band that you're targeting from here on?
So our focus is on making sure that we deliver a good stakeholder value over a long period of time. Our fundamentals are very strong. We have a strong business model. Many of the businesses that we are in, we have a large market share in terms of how much we originate on a monthly basis. And that's something that we'll continue to work with.
All right, a word on asset quality then. There is that fear that keeps creeping up, that things are slowing down, maybe people are borrowing a little too much, punching over their weight. What are your observations, sir, in terms of customer behavior? And any worries, or you think, whatever we are seeing are just knee-jerk and it's par for the course?
So we are the business of risk management, and it's a fundamental business that we do is manage risks. As I said, a 17-year-old company manage risks through cycles. We're very conscious of how we manage our risk and our cycles. So it's something that we have done over the years and quite confident of continuing to do so.
How would you maintain your yields from here on? Because I'm looking at your secured and unsecured mix. Secured is close to around 71%, unsecured about 29%. Where do you see this mix going, and how would that impact your yields?
So again, our yield is really a function of the product mix that we generate. And the way we think about our products is that we will typically have a annual tactical plan for capital allocation for each of the businesses we are in. So every business that we have will have a certain amount of cycles, and we make sure that we are allocating capital to the businesses that we think are the best from a risk-adjusted return perspective for this year. And that's how we allocate capital. In terms of our March 31st number, our secured was about 73% of the book, and unsecured was 27% of the book. It changed marginally from the prior year, again, primarily because we focused our business on businesses that we believe have a better asset cycle at that point of time.
So as of what we speak, for this year's annual tactical plan, what is your capital allocation veered more towards?
So we'll broadly be, as I said, about 75% to 70% secured, and 25 to 30% unsecured. So that principle will broadly stay.
All right, take that point for now. Congratulations on a listing once again, and wish you good luck. Hope to speak to you every quarter, and perhaps hope to speak to you at a time when you consistently grow over 20% as well, with your NIMs in that 7.4 to 8% band, and the asset mix changing as per the asset cycle that you deem is fit, which improves your return on capital employed from here on as well. With that, we'll shift into our special segment. We get you a few ideas for profit. Our colleagues from Money Control Pro join in. Anubhav Sahu has a stock that he's been tracking.
Well, the chemical sector has gained a lot of attention in recent times. Now, this sector has been dragged by elevated channel inventories, soft demand in the end markets, and dumping from key countries like China, Russia, and Korea. Now, few of these factors have rectified. Channel inventory has normalized in some of the product value chains. Raw material prices are likely to moderate, which in turn has helped the sector in fueling gains recently. Now, while prospect to anti-dumping duty for the array of chemicals are positive for the sector, we believe execution ability for the chemical companies in the dynamic new world order would be a key differentiator. So we have a switch idea when we are advising investors to trim their position in Balaji Amines after a sharp run up of 60% since April 25, and instead take exposure in Nosil. Now, Balaji Amines have an execution approval challenges for new products like electronic grade dimethyl carbonate and dimethyl ether. Nosil, on the other hand, is executing well on the export side, which make up about 35% of sales. Domestic market is sluggish due to dumping. That said, here companies seeking anti-dumping duties on product basket, which account about 40% of sales. And lastly, valuation has sobered down materially, and that's why we are constructive on this space.
All right, Anubhav, thanks a lot for that. Meanwhile, we have taken a slight downtick on the market. It's because of the IT index. The IT index, which supported the index earlier, the frontline index, is now coming off the highs. We have the Nifty IT. The index comes up for you on the screen, currently at the lower end of today's trading range so far. Still higher by about 0.2%, but fairly off the highs by about percent or so. At one point, it was up by almost 1.5%. Take a short break, come back. On the other side, we have the management of Allied Blenders joining us in the studio. Stay with us. Welcome back. You're talking to us on a Wednesday morning, a little too early in the week, but we have an important discussion lined up for you. The management of Allied Blenders and Distillers joins us to discuss a whole host of things. One of them, the Maharashtra excise duty hike as well, but more importantly, the business outlook of the company. The managing director, Alok Gupta, joins us in the studio. Thanks a lot, Alok, for joining in.
Thank you very much.
Let's address the Maharashtra excise duty first, because that was something that was discussed by everyone by and large. You as a player could give us two basic numbers. One, what proportion of your revenues comes in from Maharashtra? And because of the excise duty hike so far, what would be the increase in end user prices?
So our share of volume is sub 10%. The way we are reading the excise policy for now, it will definitely have an impact on volume. We could see about 20 to 30% reduction in volume. But there is also an opportunity on MML. And I think we are well positioned to take advantage of it because we have capacities to be able to do that. However, there is a bit of a volume margin balance. That is the tightrope that we are currently walking on. As the policy contours are not fully known, I think it's difficult to figure out if there will be any margin impact. And therefore, we are at an Excel stage. We believe there could be a solution, but the market will definitely go through a significant change in terms of the product mix.
So how much will the price increase by because of this excise duty?
Well, if we were to take current EDPs and just pass it through with new excise duty and distributor and retail margin, the increase should be north of 50% in many segments.
Got that. Hi, Alok. Good to see you in the studio, and congratulations to you as well as the team in terms of the listing. I was just doing some rough math on the Officer's Choice, which is your key brand. You know, if someone bought 2 bottles a year or so ago, then good for them. They had a good couple of months. But if someone bought the stock instead of that, the 3rd bottle would be free today.
That is true.
That's on a lighter note. Yeah. Let's get a couple of numbers out of the way then. You know, in terms of volumes, how many cases are you looking at to sell this year? Your realization as well per case is roughly in the vicinity of around 1,000 rupees. So how do you see both these two numbers headed? And obviously, premium and above is going to play a bigger role. And you'll have said in the past as well, you're looking to increase this share.
That is
what?
So essentially, the way we have looked at our legacy portfolio, which we call as a power portfolio, and the new brands that we are launching, on Officer's Choice, which is our flagship brand, the focus is really on getting the gross margins right. We are north of 40%, and we want to maintain those margins. So the guidance is a single-digit growth. Okay. On the P&A whiskey side, we've got 3 beautiful brands. We've got Officer's Choice Blue, Iconic, and Sterling. Iconic, as we know, has been a blockbuster. It's been, in 2 years in a row now, the fastest growing spirits brand in the world. We did 5.7 million cases last year. The brand continues to grow, and we will see over the next few years high rates of growth. So we expect market share consolidation in what we call as P&A whiskey. We've also launched a brand called Golden Mist, which is a deluxe brandy in the southern state. So overall, what we are looking at, volume to grow in double digits, but value to grow mid double digits.
All right. So
and Iconic, as you said, 5.7 cases, if I got that correct.
5.7 million cases.
Million cases. So if that's going to grow at a faster clip, where do you see that number headed? And we just have the entire volumes last year was around 33 million cases. So where's that headed?
So if you ask me, mid to long term, this brand has enough legs to be a market leader. So we are currently at sub 6 million. So there is enough and more juice left in terms of what market share this brand can get.
I want to talk about your product share in general, because India, yes, it's a brown drinking country. We have almost 80-85% of the revenues for the country coming in from whiskeys as against the others. But the others are also growing fast. In your case, your revenue from whiskey is 95-96%. You have the Russian standard vodka. You're talking about gin. You're talking about other players as well. So what would the product mix of the company look like, and what's your aspiration here?
First, a quick data point. About 95% consumption in India is dark, which is brandy, rum and whiskey.
Got it. Okay.
Of which whiskey is 65, and roughly 5% is others, all whites put together. And these ratios have not changed over the last 30, 40 years. Got it. So pretty much, plus minus 1%. So I think our love for dark spirits has been there for the last 50 years. We love whiskey. Now we love whiskeys of all kind, not just Scottish kind, but we're also drinking a Taiwanese and a Japanese and a Thai whiskey and a German whiskey. So I think we just love whiskeys. So that's really the broad construct. What we're trying to do here is that we have a powerful portfolio up to, let's say, 1,000 rupee price point. Then between 2,000 to 5,000 rupees price point, which we call as super premium and luxury, about 3% volume of the 420 million cases last year is there, but that's really where the bulk of money is. So all the brands that we're talking about, whether it is Russian Standard, whether it is Woodburns, whether it is Zoya, whether it is Art House, whether it is Pomori, they're all operating at a price point of 2,000 to 5,000. And roughly 98% of the luxury volume is between this price point.
Got it.
So going forward, the focus is on what we call as the luxury segment. And just a little trivia, for every 1% volume gain in luxury for us means 9% value gain.
Got it.
So the impact is just disproportionate.
So make it simple. You are at around 31 million cases as of last year. You had given us a roadmap to 50 million cases. By when do you reach there? And once you reach there, how much higher will your realizations be versus last year?
So we are 33 million cases last year.
Yes.
We had said that we will go to 50% P&A. There was no guidance of 50 million cases.
Yes.
The idea was that we'll go to 50%, and I think we will hit the 50% P&A in the next 3 years.
Okay. And what will your overall realization look like that time?
So we should see overall realization, let's say on an annualized basis, it should be improving by at least 2.5-3% year on year.
Okay, all right. Let's talk about market share then. Officer's Choice, I think it's holding on to a mid 30% market share, if I got that correct. Right. Can you hold on to that? Point number one. And point number two, debt reduction as well. What is the updated net debt in books? I'm looking at the finance cost. I think that's come down a little bit. RBI has cut rates as well, so that gives you further legs. But what kind of a debt number should we be looking at by the end of this year? And interest cost as well, I think, should come down. Yes.
So Officer's Choice has about 38% share. We are quite focused on maintaining a gross margins. So what we'll see is a profitable growth. And the brand will hold on to its market share, but importantly, keep delivering on the margins. On the interest cost, pre-IPO to now, our interest cost down about 25 crores a quarter. Yes. We expect this to come down even further. As far as this financial year is concerned, we went from last year H2, we were already positive cash flow. This full year, we are positive cash flow. So now we are generating enough cash flow to be able to sustain our growth capital need. Yes. Right? If at all there will be borrowing required, that will be for any capex and M&A that will come along. But the business is now going to generate enough cash to meet its own needs.
Is there any M&A on the cards?
Well, I think is there anything that will announce in the next couple of months? The answer is no, but I think we will stay on active lookout if something comes across. Okay, and if you want to guide us in terms of which part of which segment are you looking at if there is going to be some M&A? So on the front end of the business, it's clearly going to be in the luxury space if something comes along. And on the backward integration, if a interesting raw material asset comes along in a large market for us.
You know, one thing that we've noticed you've done ever since you've listed is you've used your listed company clout to negotiate better deals with some of your suppliers and vendors. How much has that impacted your working capital, your margins positively? And how much more are we seeing in terms of margin improvement from here on?
So FY24 to FY25, we have seen a 6 improvement in our gross margins.
Yes.
50% of this has come on back of what we call as a rate reset. I mean, our vendors were very, very helpful during our pre-IPO phase where we had a bit of a working capital crunch. And essentially, we renegotiated our rates with our vendors, and we have been able to improve our gross margin by about 3% purely on rate reset. About 2% has come from internal efficiencies, which is in terms of where we are buying, how we are buying, what we are stocking, and about 1% has come on back of better commodity cycles. So of this 5 and 6%, I think 5% is sustainable, and we'll see it, in the years to come by. We don't see any change from a working capital point of view. I mean, from number of days payable, it's sub 30 days, and we're quite comfortable where we are.
All right. I'm looking at FY26 revenues basis, all the things that you're saying so far. A little over 4,000 crores is a possibility.
Yeah, I think it's a reasonable guidance that we should be in and around that.
With around 13-14% margins?
Well, I hope so.
And earlier, I recall you'll have gone, most of your guidance has been achieved, but the bulls on the stock will want to know whether you maintain that guidance of close to 5,500 crores of revenues, say in the next 3 years, as well as margins in mid-teens. Holding on to that looks like a possibility.
Well, we exited at about, let's say, 3,600 crore last year.
Yeah.
Our guidance is that we should grow our revenue about 15% year on year.
So then mathematically,
we'll get to a number.
All right, take that point. Thank you so much for joining in, Alok. Wish you good luck. And as they say in the alcohol industry, cheers. I would know that, but I do definitely.
I can only say drink responsibly.
Absolutely. And the bulls and the bears, that's about the market, right? Some drink in celebration, some in, yeah. So, but anyways, thanks a lot for joining in.
Thank you very much for your time.
Well, time to slip into a short break. On the other side, we'll focus on some stock-specific action. We'll also track the markets for you. Don't go anywhere. Welcome back. Keep an eye out on the broader markets. A couple of stocks are moving well. Welspun Corp has moved to the high point of the day, so good going on that. On the flip side, you have Keystone Realtors. The stock has seen a good run in the last few days. It was up 7%. Now it's up only around 3%. So I think you should keep an eye out on that name as well. Venus Pipes is the other one that was up close to around 8%. I think now it's up close to around 5.5%. So some kind of profit taking from the top is what we're seeing on that one. And I think Vimta Labs, we don't talk about it very often, but that as well is showing some traction. Add to the list, and Apollo Tyres as well. Mangalam.
Consumption stocks, Nigel. That's what I'm watching out for right now. Britannia has moved to the high point of trade. We're seeing some traction in Titan ahead of its first quarter update. Brokerages have expected, this quarter to be a good one. But importantly, keep an eye out on Asian Paints. This morning, we had, pointed out that there is that Competition Commission related issue that may keep the stock slightly under pressure, but that dip has been quickly bought into. The stocks moved back into the green. So we'll keep an eye out on this entire pack. With that, we are out of time on this edition of Chartbusters, but you stay tuned to CNBC-TV18. The team of Trading Hour comes up next.